We are now getting the latest breaking news that China has halted natural sand exports to Taiwan after this visit. We're hearing that that is actually a component necessary for the production of semiconductors. You don't necessarily like Taiwan at this moment. Underweight Taiwan and Korea equities. Tell us how this actually really heightens your view.
Certainly. So there are fundamental drivers behind this, in addition to what we've seen an increase in geopolitical tensions between China, US, and Taiwan. Fundamental drivers as such, the base case for us is that we expect global growth to slow down, and export heavily dependent countries like Korea and Taiwan will be extremely vulnerable. We expect to see a slowdown in the exports in those regions. And in addition, if you take a look at the data from 2020 and 2021, we've seen excess oversupply coming out of Taiwan, specifically on tech components. So we expect the outflows to continue on the back of slower demand, on the back of geopolitical tensions, and the equity markets and the FX markets to lag in this space.
You're also not liking the offshore yuan, despite the fact that it's been pretty resilient. Why?
Yeah, so our point of view is as such. The China PBOC has the capability to actually ease and is actually going against the direction of most central banks in the world. So with inflation in China fairly benign, and with China really wanting to support growth, we expect the interest rate differential between China and most of the DM markets to actually widen, especially versus the dollar. In addition to that, if in our view that where global growth is expected to slow down, we expect the trade balance in China to actually weaken more, and this will actually weaken exports, slower demand for exports, and that will actually further weaken the yuan. So in our view, the CNH is likely to weaken towards perhaps 6.8 or 6.9. That's how we see it.
When it comes to equities direction, does it feel like markets are looking for an excuse to be optimistic, despite the fact that there is still a lack of support when it comes to the Fed pivot, as well as the fact that guidance and outlooks from corporate earnings have, on the whole, been pretty bad?
Yes, we do see animal spirits coming in. Everyone reading between the lines of what the Fed will likely do in the next coming few sessions. We're still in the camp that the Fed will push deep into restrictive territory. Year-end at Fed rates between 250 to 400 basis points would be possible. We expect that to eventually slow demand, result in economic contraction. We've seen 2 quarters of consecutive contraction in the US. We don't think it's the end. We expect to see a few more. And if these come in consecutive quarters, I think it's really hard to deny that a recession is definitely on the tables. So the natural knock-on implication would be a downgrade in earnings. And if that happens, we expect equity markets to sell off further. So we're fairly cautious on this front. Even though we saw some animal spirits early on, we don't think it's going to last.
Ray, where do you see the biggest risks when it comes to the credit space right now?
Yeah, within the credit space, it's mainly, for Asia specifically, it's mainly in China. The main issue around how the property market may potentially blow up even further, even with the China Central Bank as well, the China policymakers wanting to focus on China housing being for people to stay and not for investments. That has actually seen some knock-on implications across the broader credit space. We've seen sell-off and widening of spreads, not only in China, but also in broader Asia markets, even though most other Asian markets have very little exposure to China. So some form of contagion knock-on implications would lead as a result of this issue. Within our space, as active managers, we do see significant opportunities to actually get those that have no relation to a China-related sell-off. Spaces within India, spaces within the ASEAN space, they look pretty attractive right now, and we look at good credit spreads at credit levels right now.